All right. All right. Good morning. Comment allez-vous. How are you? Welcome to Forex.Today, the YouTube community of more than 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance because trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Hello, my name is Wayne. Good to see you. Welcome to Forex.Today. Let me know in the chat what you would like me to cover, and I will do... wait, that's not my microphone. Oh, and I'll do my best to address your needs because you're my sweet baby. So let me know what you want. Do you want euro? Do you want dollar? Do you want yen? Do you want a particular cross pair? Do you want gold? Do you want oil? Do you want Bitcoin? Do you want stock market? Do you want, I don't know, Litecoin? Let me know. Okay, cool. Yeah, so let me know how I can help, and I will do my best. Oh, I forgot to do this. I like doing it this way, though. Hang on, youtube.com/forex.today. Let me bring it over. Here we are. Cool. You go here. Cool. And then you go here. Look, click more. Below the video, there's a bunch of things. First of all, we're doing a party. Why don't you come to the party? It'd be really good to see you. We're going to have dinner. Yeah, we're going to have dinner. 5 p.m., meet next to the library. 5:15, group photo. Okay, right? Then we're going to have our steak dinner. And then we're going to have our digestifs. Here's what it looks like. So we'll have dinner in the restaurant, and then we'll have cocktails and coffee by the library. And then if you want to go ride a mechanical bull in your church clothes, you can do that as well. Very cool. So that's only 2 weeks away. By the way, if you're in my CIA group, I will be posting information and sharing information in the next day or two. TBO says, no cigars as well. No. The local, this is outside the actual downtown area of Nashville, which is really cool and upscale, and they have several different places for cigars. We're quite a ways away from that. So the other problem is if we were here, I think you have to arrange for a place outside, and Nashville's cold in December, but everything else is indoors. Like this whole restaurant is indoors. You see all these glass atriums in the background? Yeah, it's really cool. So once you're checked into the hotel, this restaurant's inside that glass atrium. So no, we can't smoke cigars there. But the cool thing is once you check in, it's warm and tropical. Yeah. Cool. So come to the party. 4-course meal, right? Enjoy a 4-course gourmet meal with me. Cool. Cool. All right. How about a trustworthy and ethical broker that doesn't trade against you? Tradersway.com is an ECN, which means they don't trade against you. 88 hours of training videos, investorbootcamp.com. You want a free lecture on trading stocks? Right there. Boom. Bada bing, bada boom. That's good. I had to feed Aiden yesterday over at tradeplans.ai hundreds of dollars. specifically hundreds, and hundreds of dollars. So I hope you use tradeplans.ai. So what you do is you post your trade plan and boom, you'll get a private email with feedback on your trade plan. And it takes less than 1 minute. Cool, right? It's like having a mentor. I've taught AI how to trade. You should try it. It's really cool. Fundamental analysis, you want to learn more? I wrote a book. I'm writing more books now, but there's my first book. How about an hour and a half? Not quite, hour and 20-minute free Forex training course? There's a link there. All these resources are made available to you. You should check them out. Boop. Cool. So thank you for being here. Looks like the bowling ball's dropping, potentially. Oh my God. By the way, that's not Fibonacci. This is a tool that I've programmed myself using my methodology. Nobody else uses this methodology. And look how accurate it is. Yeah. Way better than Fibonacci. Okay. Yeah. This methodology is rare, more rare than a six-legged sea star. No, you can't have it. Nope. Nope, totally not. So this is the S&P 500, and to look at it from a different point of view is a top forming. Andreas, I'm kidding. No, I'm not kidding though. Yeah. Yeah, so this is the big deal, everybody, because the possibility, one possibility is that. Well, Andreas, all I did was change my Fibonacci tool from a 618 to a 66. 66.6666. It's trying to show that people spend way too much time worshiping their indicators instead of thinking about common sense. And I think it's ridiculous that gurus sell training courses based on the magic of the golden ratio and the genius of Fibonacci. And in fact, it's natural powers over the market. Like the pattern on the side of a pumpkin. Not a pumpkin, pineapple. Like the pattern on the side of a pineapple. It's just that natural. You can't fight the forces of Fibonacci. And you're like, gee whiz, what a load of crap that is. So ridiculous. So anyway, so I changed my Fibonacci from a 618 using the magic of The golden ratio. No. I just used a 6.6 instead of 6.18. There's nothing magic about it. It's 2/3 of a pullback. Nice. Genius. And that's the same pattern as the skin on a sea star. Yeah. The flowers on of a lotus. It's just so funny how much garbage is out there, huh? So anyways, massive potential here. Massive potential for a change in direction. Okay, we had an uptrend. We had a sideways trend. This might be rolling over. Like an old man easing into a hot bath. So this is going to be the thing that leads us. Now, what I think is happening is we're farting around while we wait for PCE on Thursday. Okay. But I do want you to notice what's going on the multiple time frames here. Okay. And it might be topping out. Now, instead of doing that over and over and over again, let me show you another trick. Okay? Because I constantly do that, whether I draw it or not, I'm constantly doing that. But you can go to Insert, Indicators, Custom, Price Action Pivot Points. And you can see I have a longer term up and a shorter term short. Ooh. And it updates in real time. Every new candle, it adds a candle and it drops a candle. So it's calculating over the last 55 hours, after the last 55 candles, is the trend up or down or sideways. It's beautiful, right? It's a combination of linear projection and standard deviation. Linear regression and standard deviation. Richard says with those FIP projections, is 618 still acceptable? Yeah. But what I'm saying is you can change them. Just don't believe that there's magic in the math. That's smoke and mirrors and an illusion for people. Okay, like here's another example of that. Okay, Richard, let me zoom in. Okay, we just hit this number here. You see? Who uses 121.4? Is that a Fibonacci number? That's not Fibonacci. I think I might be the only person in the world that uses that number. Now, I'm self-taught, so I know how I got that number. But let me just say, did it work? Seems to. Okay. So what I did is I looked at some of these numbers and I realized On a scale of to 100, there's a 61.8 that we care about, and there's a 382 we care about. And they're the same distance from the 100. And then, so I'm like, okay, well, they're obviously very close to a two-third retracement and a one-third retracement. That was the first thing I noticed. I also use 50%, which is not a Fibonacci number, but it's 1/2. Great. But then, right, I noticed that in my readings of teaching myself Fibonacci, 786 is a number. I wondered well, it's not 1/3 or 2/3. It's just kind of out there. So I wondered what it was. So I left it there and I just observed for, a year or two. And one of the things I was trying to observe is what happens if you get a 618? I found very often you go to a 1382. And if you get a 382, it tends to go to the 1618. And I thought about it and I pondered it and all that kind of stuff. And right, so here's the 100 line. So, and there's the extensions. Okay, so I thought about that and I pondered that for a long time. And then I thought, well, what about the 786? Well, what I found is very often, and I don't have a 786 on this chart, but it's about there. Very often what I saw is it either reversed or it double bottomed and reversed. Not always, but much of the time. And I'm like, okay, so 786 isn't that good. But I also noticed that very often we didn't quite hit the 1382. Okay, that there was some other number going on. But it wasn't a Fibonacci number. I also knew that by just observing. Sometimes we'd not make it to the 382. So then I'm pondering that question. Okay, so what number am I missing? See what I had to do to teach myself? I'm like, there's an imaginary number, not quite the 382, but beyond the 100. I wonder what that number is. There's no resource to go to. YouTube wasn't even invented yet, so don't go there. Oh, well, I'll just Google it. No. Okay. So anyway, so then I went back. What about this 786? 786 didn't seem to be that important, but it did predict the pullback was too much, and very often the pullback turned into a reversal. But then I'm like, well, what is 100 minus 786? And I got 21.4. And I realized that there was a relationship. A 618 went to a 1382. A 382 went to a 1618. 1618. What's the missing number less than 1382? And I realized the missing number is 21.4, which is 100 minus 786, but it's an extension, so it's a 121.4. And I put it down there and it worked just like this. Immediately I found that number. 20 years ago I did this. And it worked like a charm. That was my missing number. Now Richard says 23.6. Well, you know that. I didn't know that then. But I know exactly the thought process I went to learning how to trade. And I didn't take any indicator for granted. I had to figure out what was going on. I had to figure out the math. I had to figure out the methodology, and I had to observe it with price action in the market because there were no gurus. There were no training courses. There were no Forex books. There was no, YouTube had not been invented yet. Amazon only sold books. That's all it did. but it didn't have any books on Forex trading. So then I went to the Stanford University Library to buy books on foreign exchange because I figured smart kids studying finance and economics at Stanford would be taught how to make millions trading Forex. So I go to the library. Apparently the answer to that is no. No, that's not what's taught there. So, but I literally went to the Stanford University Library. And I'm like, no, it took a day. It's a day trip to do all that work. And I'm like, I need help finding I need help. I was looking for help. Help me. I had to go through all that to become a Forex trader. Now, you can just be some idiot loser and go on YouTube and be a guru and get people to follow you, and you know nothing. And you're not willing to do the work to figure it out. It's terrible. Paul says, what are some good hardcore Forex books with sidelines of code? I haven't read any Forex books. I still haven't read any Forex books because I figured out my methodology before there were Forex books, and I haven't changed. You should watch my videos from like 2006. Same stuff. Johnny says, my book. Yeah. But anyways, my message is that you can do this. You guys can do this. I think the biggest disservice right now are all the gurus on YouTube. Some of them are good. I would imagine most are not. That they would not be able to get a license to trade other people's money. They're probably not even smart enough to pass the test or have enough money to actually pay for the licenses. Yeah. Right? So that's probably the biggest disservice. But what I'm trying to teach is reality as much as possible. The indicators are not necessarily that important. You have to understand some basics in investing and trading, and then you can layer on whatever indicator you want. It really doesn't matter. If you understand the basics, then you can add those things. But of course, that's not what's taught. You're taught is just to worship an indicator, and it'll tell you what to do. Complete garbage and nonsense. And then I also teach that you should probably understand what's going on in the economy, what's going on at the central bank, what's going on global money flow, because these impact, currencies, because a currency only changes value if it crosses a border. If you have a closed economy like Cuba, a peso is a peso is a peso is a peso. Nothing changes. Okay? Now, I've been to Cuba twice this year. And when I first went, inflation was 100%. When I went again, 5 months later, it had gone up another 100%. So how is that even possible? Well, the peso stayed exactly the same. The thing is, there was lots of demand for dollar. So by me kind of sneaking into the country with my dollars, there became a black market, and a closed economy became somewhat of an open economy, meaning people wanted my dollars. And the value of my dollar doubled, but the Cuban peso stayed the same. It's always been the same. It's never changed. So the only way for money to change value is for money to cross a border. So it just basic logic, which I don't think gets covered enough, is that we need to track the flow of money around the world as it crosses borders. And so things like global trade, matters, doesn't it? You would think, right? Okay. So you need a sound grasp of macroeconomics. So at Harvard, my macroeconomics professor, I literally, when I took an advanced class on macroeconomics, and it was so hard. It kicked my butt. Almost. I mean, look. I can't express how difficult it was. Now, granted, I had to teach myself calculus to do all the work, but nonetheless, it was a very difficult class. My professor was an active senior economist at the Boston Fed. He just came over to Cambridge at night to teach the classes. Pretty amazing. So your average, I don't know. It's a hard class that I think if you can't pass that class, you're not qualified to teach. If you've never passed the Series 3, for example, like YouTube should come up with a rule. If you're going to teach people commodities and currency trading on YouTube, you need to have a Series 3 license. Do you know what would happen? 90% of YouTube gurus would be kicked off the platform because I don't think that they would be able to pass the Series 3. It has a 70% failure rate for those that are in the industry. So anyways, I'm just saying be careful, guys. Paul says you were able to do some work and find the right book, in particular dialogue and writing style. Yeah. What book is it that you found? I might have missed it. I'm intrigued with the writing style because it's interesting. You can write a book, and then you can go back to the beginning and rewrite it with a different tone. So I got to find the tone for the various books that I'm writing. And in particular, I'm writing a book set, a set of books, 3 books. And by the time I'm done the 3rd book, I have to have the same tone as the first book. And that's not that easy. So really what you end up doing is writing the 3 books and then going back and then rewriting the 3 books with that current tone. But then you also have to decide on a tone, right? So anyways, writing is fun. So anyways, good. We stopped at the 121.4. We're back inside the range. Okay, we're back inside the range. Now, what you would do for Fibonacci is you would move this, and you would probably get ready to try again if you're a bear. Yeah, Paul agreed with, I believe, the statement of, YouTube gurus wouldn't be able to pass the Series 3. The Series 3 is interesting because it covers commodities and options and very, very little Forex, almost no Forex. But to be a Forex trader, you have to do that, and you have to do the other one, which is all just Forex terminology. The interesting part of it is that they make it difficult enough where there is not enough time. So not only do you know the information, and you got to know it hard, And there's a lot of regulations like how long do you keep your track record? How long do you keep complaints? Where do you keep your complaints forward? What do you report? When do you report? Right? All these different, things that have nothing to do with trading, but running your trading business. But there's not enough time. And there's quite a bit of math, because you got to figure out the right thing. Do you use an option? Do you use a future? How much did it change? What is the term? What is not, what is the basis? All this stuff. But there's not enough time, so you have to have a strategy on top of that. You can't just know the stuff. So people with 10 or 15 years of experience fail the exam all the time. So on top of that, you need to be able to burn. So what I did, and this was back when it was fairly new on computers, what I ended up doing is I burned through all 300 questions. And I think it's like 300 questions in 3 hours, but I don't know. Maybe it was 100 questions in 2 hours. I don't remember. But what I did is I either knew it stone cold or I skipped it. Then I went back. Oh, or the other thing is I knew it stone cold or it was math. Like it would take time. So knock out all the easy ones. Pick all the low-hanging fruit. Boom, boom, boom. Next, skip, 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 answer it. Skip, skip, answer it, answer it. Skip, answer it. Skip, 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 answer it. Skip, answer it. Skip, skip. All the way through. Then go all the way back to now it shows you which ones you haven't answered. So go all the way back to, is it that you don't know or is it mathy? So then you'd go, okay, this one I'm not sure about. Can I just eliminate two of the answers and get it down to 50-50? Yes or no? No. Skip. Okay? And then you end up going back and there's the ones you really don't know and then the ones that take time, the mathy ones. So now you go back and you do all the math ones and you calculate it, knock it out. Because the idea is, what if you get down to the last 15 minutes and you just finished math and you've answered all the ones you know, and then you've kind of took decent guesses at the ones you don't know. So now you're just like blank. You got 15 or 20 questions and you're just like, I don't know at all. Like but now you can guess like crazy, but you left those ones last, right? And so now you go in the last 15 minutes and you're only spending 10 seconds per question because you're like, I don't know this one, and it looks like it would kill 10 minutes trying to figure it out, so I'm going to spend 10 seconds on it. So I don't think it's A. It might be B, C, or D. Pick one. Next. Just instead of wasting 10 minutes, you waste 10 seconds. And usually you have a 50% chance of getting it right because you can maybe at least eliminate one, and you're pretty sure or maybe you got a 30% chance. But the thing is, the time is the killer. What usually happens is people just go in order. So they get the easy ones. They get the easy ones right, but they take a little too long figuring it out because they want to be accurate. And then they get the other ones. They waste just as much time on the ones that they're not going to figure out. They're trick questions maybe. And they waste just as much time on that. And then they go on the mathy ones, and you get to a question that takes you 10 minutes, and then you answer that. And by the time you get to the last 15 minutes, you're only 2/3 through the test. You're not going to finish. And that's what happens to most people. Now, if you don't know the stuff, if you haven't studied for 6 months to a year, you're just a failure anyways. Just a bloody mess, wasting everybody's time. You got to go in, because remember, the test isn't about passing. It's about, are you an industry expert? So if you go in with, I'm an industry expert, and I've studied, and I have a methodology, yeah, then you got it. All right, moment of truth on the fitty. Moment of truth on the fitty. Moment of truth on the fitty. We'll see. Yeah, there wasn't anything like that I recall, Richard. Like, gamma or theta, that kind of stuff. No, they'll ask some questions on black shoals, I'm sure, but not really the mathy side that I recall. Like you would need to know what it is. They might have a follow-up question about long-term capital management. Yeah, and they'd probably throw in a risk question in there. But the ones I remember a lot were things like a farmer takes his wheat. Now it's probably his or her or they. A farmer takes they wheat to the grain elevator operator, and prices are at $152 a bushel, and what is the concern is that prices are going to go up, or the concern is prices are going to go down. What is a proper hedging strategy? And then they give you different options, A, B, C, or D. And now the first thing you have to figure out is, all right, who's worried? Is it the farmer, or is it the grain elevator operator? You have to figure out what side you're on. And then, okay, what are they worried about and what do they want? So a grain elevator operator would actually want price to go up. So they're worried that price would go down. But the question had to do with the price is going to go up. So what would they want to do in that situation? And so you go through the different choices. Well, okay, that's protecting from price going up, but that would benefit them. So that wouldn't be A. That kind of stuff. You got to go through it. And most of the time you just read the question wrong because you answer it like it's the farmer. But no, the farmer just sold it. He's done. Farmer's done. He sold it to the grain elevator operator. So he grew it from seed to harvest, dumped the whole thing off at the elevator, and he's done. He got paid. He doesn't have worries anymore of prices going up or down. But an elevator grain operator that just bought, let's say, $1 million worth of grain isn't worried that the grain that he now owns goes up. You see? If it goes up 10% in value and he sells it to other buyers at 10% more, that's golden. Okay, you see? So it's those types of questions. So you'd have to know, and it would tell you different options contracts or different futures contracts, that kind of stuff. And they might ask about, intermarket spreads, crack spreads, that kind of stuff. So they'll bring out a question on soybean meal versus soybeans. They'll talk about Kansas City wheat versus Chicago wheat. It's a commodities class. The relationship to gasoline prices and corn prices, and then regulations. Because you're preparing to be a regulated entity, so they need to know the rules. Oils Oscar Mike, yeah, that makes sense. Well, it just bounced off the bottom, right? So it's still in a range, but are you buying it at 75, Johnny? Oh, sweet. Nice trade. Well played, sir. Well played. Revelation's got it too. Right on. Yeah, it's one of those plans like you either have it planned or you don't. That could be like an interesting way to use options, right? You're like, I got it at that price and it either works or it don't work. I kind of miss binary options, and I'm not sure why they were so looked down upon. There must have been a lot of scammers or something, but ultimately, I kind of liked binary options. No, they're not a good way to make money, and that's kind of how they were pawned off to retail traders. But they were an interesting way to hedge, especially short term, like because really they're end of day options, right, or even less than that. So you could hedge for the day with a binary option and have it all calculated. The thing is, it's sort of like, maybe this is what the regulators didn't like it, but the math of the game is such that you will lose in the long run. It's like going to a casino. Okay. Richard says Chinese demand has come back, and that's why oil is up. Well, China's buying oil from Iran, 3 million barrels a day, and Russia, which is probably 2 million barrels a day or something. So maybe that China demand is coming back, but it doesn't mean they're buying it from the open market. And also, you have to understand that these relationships are long-term contracts, right, Richard? So if China has an economy that returns to expansion, and it's not, but if it did, then they'll go to Iran and say, we'll give you $50 a barrel for the next 5 years. Done. 50, and that's it. And they're out. So now all that oil goes straight to China, and the oil doesn't hit the open market, but it does lower the price because nobody's paying the higher price. And they're long-term contracts. So it's very rare that a country would go to the open market and pay a spot price. Right? And remember, Europe put a threshold price. It was $60 or $65. Remember that? And they were going to police it and board all the oil ships out at sea and determine whether it was Russian oil or not Russian oil. I mean, how ridiculous, right? But anyways, the EU placed some sort of price ceiling on oil, which is great for China, because then they go to places like Russia and Iran that are sanctioned and say, well, you're not allowed it, right? You can't sell it for 65, but we'll tell you what, we'll pay you 45 right now, and we'll buy every drop of oil. So yes, it's $20 less a barrel than the open market, but here's the thing, you will be guaranteed $1 billion a day forever. Or you can go fight the EU and the US over sanctions and such. Or we'll just give you $1 billion a day forever. What do you think? And they're like, you know what? $1 billion sounds pretty good. Right? So those are long-term contracts. And then, of course, if you can then use options or futures to hedge that if you want, right? But anyways. Hey, Paul, if you're still here, you were saying you were looking for a book with particular, not just tone, but you had said something about like you want some of the math. Oh, there it is. A hardcore Forex book with some lines of code. Express that a little further. Maybe I can just write it for you. For us, I can just write it. Richard's watching CFTC. So just so you know, guys, this is what you can do. You can go to the Commodities Futures Trading Commission. It's a government agency, U.S. government agency. And you can go to the Commitment of Traders report. Okay, you want to go at financial futures. And you don't want options. November 21st. Okay, as of November 21st. And you can just look at all this data. And you'll see Japanese yen. Okay, positions. Okay, long positions, short positions, by dealers, by asset managers, long positions, short. See, it says long, short. And the differential. Leveraged funds, maybe a hedge fund. Okay. Contracts long, contracts short, differential. Okay, retail, long, short. Okay. No, wait, wrong. That's other reportables. Non-reportables. Here's your retail. Long, short. Cool. So that's the Japanese yen. And they have all the different assets you want to look at. South African rand. Shut the back door. Yep, got information on that. Kiwi dollar. Brazilian real. Mexican peso, Australian dollar. Okay. So on and so forth, right? There's your British pound. There's your Swiss franc. There's your kitty cat. Good to know, right? See how easy it is? Rolling, rolling, rolling. Rolling, rolling, rolling. Rolling, rolling, rolling. Okay, cool, right? Oh, Commitment of Traders report. It's the same thing I just showed you, but this is how it's displayed. CAD is the worst, the weakest as far as positioning. This is institutional positioning. Institutions are heavily short CAD, heavily long dollar, heavily long gold. That's the stock. That's the number of contracts long minus the number of contracts short. That is a total number. Number of bulls versus number of bears. Those are long term. Then you could say, well, what's changed week over week? Where's the flow of capital? Okay, and it's into the Japanese stock market and into euro, into silver, and into the US dollar. Well, the dollar's been weak. Well, according to the most recent information, a little bit of money went into dollar. Now, it's 78.35% long. Wow. Let's flip it. Money came out of platinum, money came out of Swiss franc, money came out of NASDAQ, money came out of the pound. Rolling, rolling, rolling. Okay? So you don't want to just look at net long or net short. You want to look at the differential week over week. And that's something that the COT data can't give you. Okay? Cool, right? So anyways, there's the analysis of the flow of capital into assets and out of assets. That's the cash flow. And then this is the stockpile of cash, if you will, futures positions. So this got a little more bullish than last week. Okay? And CAD got 0.5% less bearish, but probably not a big change. It's good to know though, right? And much easier to read than actually reading the Commitment of Traders report, which I used to do. Okay. The other thing that QuantBox will help you do is you pick your asset, and green is euro, red is the second asset, is dollar, and money went both into euro and dollar. But the market still favors dollar over euro. Okay? So there's still a negative bias even though price is going up. How does it explain that? Okay? And that's the difference of the net. This is right. So more money is going into euro than dollar, but money is going into both euro and dollar. And you can see that because these are not, right? To do these calculations, it's euro long minus short. Cool, right? Cool. Oh, and remember, people used to sign up for what we call QuantBox Retail. It's a light version of QuantBox. I gave everybody the professional version for no additional cost. I gave every single client that was retail, I gave them access to the professional database at no cost. None. So if you were thinking about it, if you were thinking about it and you're like, yeah, but I really want the Pro, but I can't afford $800. No, it's $79 now. You're welcome. It wasn't a Cyber Monday deal, but I did it a week and a half ago. I just did it, I don't know, to thank people that have supported QuantBox from its beginning. And I wanted to show you that I've been reinvesting all the capital back into the company. I haven't bought a yellow Lamborghini. But if you want to see the upgrades that I did do, I posted it here. Oh, wait, is it not going to be there because I'm already a subscriber? Interesting. It's probably under live. Yeah, this one. Another $500. This is me rehashing the original
to this information. Calls.
Which accumulative and non-accumulative. The huge lump sum up front. How many people would like a monthly subscription to access all the new features and the additional pairs? And by the way, like 20 people said they would pay the $99 a month. Probably 30 people said they would pay the $99 a month to access the professional version. You now a little sweeter for you, because this isn't a sales pitch. Yeah, I swear to you, this is not a sales pitch. How about $79 a month? Think what? Wait, what? But that's the retail subscription. Retail is $79 a month. So that doesn't make sense, Wayne. It does. As of right now, all current retail subscriptions have been upgraded to Pro. You now have access. I gave it to you. I gave it to you. You now have access. It's done. If you try to log in and it's not working, they're literally right now adding people. So I just moved everybody over to Pro. You're welcome. No change in your subscription. Same price. I just want you to have everything that's been built. Boom. Compliments of the firm. Yee-hoo! Awesome. Thank you for being a subscriber for, what? Again, it's got to be 18 months. I don't even know for sure. Has it been 18 months? Has it been 2 years? Somewhere in there. You've been a contributor to the success of this business, and I'm reinvesting back into you. I'm reinvesting everything back into the service. And so anyways, cool. So compliments of the firm. I just did it. No Cyber Monday. No coupon codes. No nothing. Cool. So anyways, now we're farting around waiting for the stock market to open in 15 minutes. And we're right on that 50. We're right on the 50. Rolling, rolling, rolling. Rolling, rolling, rolling. Cool. So we'll see as the money starts rolling into the market. Will it pick a direction? Is it going to be a risk on day? Is it going to be a risk off day? I can tell you that when QuantBox met several hours ago, we saw that it was leaning risk off today. It was leaning to the risk off. So we'll see how it shapes up. Yeah, that's how it was leaning. And remember, there's two different methodologies of measuring market sentiment, real-time market sentiment at QuantBox. There's two different methodologies, completely different methodologies. They don't even look at the same, way different math, completely. Okay? Completely different. And both of them were, one was neutral to bearish, and the other one was somewhat bearish. So we'll see if that continues. Remember, it's not projecting anything. It's just telling you what is happening. You just don't know at this point, are they reversals or dips? Because a dip won't go terribly negative, but a reversal goes terribly negative. And it's not terribly negative, but it's definitely not bullish, you see? So it really depends. And now we have that new market opening, so we'll see where the new money wants to go. By the way, if you're in my stock trading course, we are doing a class tomorrow. Yep. Yeah, it's going to be a very important one, in particular if you're in my CIA. Very, very important meeting tomorrow. And we're going to start the process of building a portfolio because we've already done multiple valuation models and we've analyzed different forms of risk, and now we need to start making decisions. Okay, now some people are asking, hey, can you look at this and can you look at that? Well, based on correlations, this is enough information. Okay, you should be able to look at the S&P 500 and thread together all kinds of trades. But why not? We can take a look around. Okay, hourly gold. Okay. We've hit profit target. So be careful up here. Okay. So I look at that. Gold is done for the day. And I will remind you, by the way, allow me, please. Yesterday, I went on a big speech about if you log into New York and say, hey, what's up, fellas? Are we buyers or sellers? You've already lost all your money. And when we were up there, I said what you should be doing is setting up trades based on tomorrow's trade plan. So on Monday, you should be planning Tuesday's trade. If you show up on Monday and you don't know what you're doing, you've already lost. You're the sucker at the table. Okay? So price came down after that speech and gave you a buying opportunity. What is the target that you should have had yesterday? Right there. So yesterday when we were here, you should be saying, I want to buy a dip because I'm a bull, and based on that, the target is right here. So somebody earlier said, well, what just happened in gold? Late. You're 20 hours late. What just happened in gold? Somebody that made a smart trade yesterday got paid. Okay? And an amateur trader is going to now be interested in trading this because it's moving now. Wrong, 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 wrong. Anywho. So are you asking yourself about tomorrow? Or you're like, what's happening right now? You should be executing the trade you developed yesterday, or you're taking profit on the trade you developed yesterday based on today's analysis. But if you're going through these charts looking for something to do right now, you are losing. Okay? So we talked about risk at this price level. It went higher. Is the risk wrong? No, not at all. Okay? Okay, what is happening? Do you buy a dip down in here? Probably. Do you buy a dip down in here? Yep. Do you buy a dip down in here? Yep. It didn't work. Well, you didn't know that when you bought the dip. But now it dropped down. Do you buy this? No. It dropped lower. Do you buy? No. Although this is buyable because it's based here. Okay? Then it rises up. Do you buy this? So that's a buy. Okay. It went up here. Do you buy this? Yep. Now you're up here. What does an amateur want to do? They want to buy it up here. Why? Because of the giant green candle. Wrong, 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 wrong. Okay, you'll probably end up buying it if you want to be a bull. Because remember, the genius about this indicator is that you have to tell it that you are a bull. If you don't know if you're a bull, or if you don't know you're a bear, once again, you've already lost money. You're going to lose all of it. You're adding no value to the market. You don't know what you're doing. And trading money when you don't know what you're doing is foolish. And a fool and their money are easily departed. So if you were a bull, you should know that this is a profit-taking area, not an entry. And if anything, you're going to look for this in the next 20 hours. What if that doesn't happen? Well, you're not going to get a trade. Okay? Yeah. Too bad, so sad. Okay, euro dollar on its way to 110. Now, based on the swing trade, okay, 110.33. About roughly, kinda, mostly. 110.33. Okay. Cool. That's just what it says. I'm only doing technical analysis. Cool. Let's take a look at our buddy USD yen. Does this mean it's oversold and going to go up? No, no, no. Oh, but that's what my other YouTube guy does. No, 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 no. What does it mean? Nothing. It means everybody's selling. Okay? After the lower low, though, this is important. Yes. That's a sell. Is this a buy? No, 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 no. Is this a buy? No, no, no. Is this a buy? No, no, no. Is this a buy? Yes. Is this a buy? Yes. Okay? This idea that these are buys and these are sells is wrong. And you're going to get a guru. I'm telling you, it's so easy to say, like, that means up. Okay? And this means down. See, it went down. And this means up. See, it went up. And then this went down. And this went... oh, my God. Now, first of all, it's lagging. So by the time it fell or rose, it's already happened. And much of the time it doesn't work. Oh, so you bought it here? Really? And your guru keeps telling you, oh, no, it's a buy. No, it's not. Be careful of who you listen to. Wrong. Unless they've studied it for 20 years in the real market. Does your other guru even know the math? Can they do a stochastic oscillator mathematics? No. They just watch some other guy on YouTube. And now they're doing it on YouTube. Yeah. No. Be careful, man. Be careful. So without a doubt, this is not a buy and this is a sell. What's the difference? Join an investor boot camp. You'll find out. So this is way down here, and it does not mean up. Okay? Think of it as potentially this. Because this could do, right? And this will stay oversold. It's oversold because everybody's selling it. Do not. Okay, not on that time frame. Do not buy it. Now, of course, I covered this yesterday in the day trading group. But maybe next year we'll do it as a podcast. I kind of like the idea. The week on the street. Stock market opening in 30 seconds. Going bullish. Whoa! Noise! I hope it sticks, man. I hope it sticks. Collected dividends today. All right, there's a flip on my 66. No, Jim, I think Kendo's talking like E-minis. It must be a slightly different price. Depends on market conditions, Abdullah. But to me, my favorite trades, my real trading kind of thing, like in my mind, scalping fills the gaps, if you will. But real decision making is weekly and monthly. So I'm primarily a swing and position trader. And now focused on the construction and management of stock and bond portfolios as well, much more macro quarterly focused. But scalping could be 5 trades, it could be 50 trades. Okay. But I don't think daily like that. I don't think like that anymore. I used to, definitely used to. But I'm much more, like I was saying before, much more focused on swing and position. Now, one way of thinking about it, Abdullah, is if you scalped, and I think anything less than 50 pips is a scalp, and if you're only doing 12, well, that's you do you. But the thing is, a lot of people, when you analyze their trades, they do, let's say, 2 or 3 scalps a day. And they're making 12 to 25 pips each, or losing 12 to 25 pips each. And the problem with that is because you're trading volatility, you can have a good trade but get unlucky because the vol goes against you for 15 minutes, takes you out, and then goes on to accomplish its mission. So there's a lot of luck in scalping. And really, lots of bad luck, at least for me. And I scalped a lot. I'm actually a fairly decent scalper. Okay. Now, if you only do 2 or 3 trades a day, luck, good and bad, and mostly bad, is going to have a very large impact on your overall results at the end of the year. And you really don't know if you're going to have a good year or a bad year because you're trading volatility and it comes and goes, comes and goes. You're not trading macro. You're not trading trends. You're just long, short, long, short, long, short. And you're not making any serious money per trade. And you rely a lot on winning percentage. Oh, yeah, and the stress, for sure, which actually down the road, Abdullah, becomes the unbearable risk. But to tell somebody new about trading, they don't understand that yet. In year 9, they will. But anyways, so you get to the end of the year, and it's a probability issue. You probably don't know what kind of return you're going to get. So I don't know how you can plan for that. You need to maintain a very high winning percentage to make it worth the hours that you put in. But then what that does is it leads you to not managing your risk properly. It pays you to let your losers run, but you always get out of your trades early. And if you're only, now going further, if you're only doing 2 or 3 trades per year, by the end of the year, it's, again, unplannable because you probably, based on probabilities, don't know what your return will be. Will it be 10? Will it be 100? Will it be negative 30? Well, you have no consistency to plan because every day is a new day. Every trade is a new trade. So the next thing you need to do, if you're going to scalp, you need to do 10 to 25 trades a day. Because then every individual trade in of itself has less weighting of uncertainty. Okay? Because if, let's say, 60% of your trades are winners and 40% are losers, you could have 5 winning trades in a row. But if you only make one trade, there's a high probability it's a loser, and now you're done, right? So what you do is the more trades you make, mathematically, the less randomness you get, and the more sort of smooth your curve gets. So again, typically when I see a new trader, they're like, Wayne, will you mentor me? I'm really good at trading, but I don't make any money. And then I see that they're doing 2 trades a day, and they're trading at random times. They're trading for random reasons, and they're upset that they're inconsistent. And I'm like, well, your trading is random and your results are random. So why are you emotionally not connected to this? So if you traded 25 times a day and you made 5,000 trades a year, there's a lot less randomness to it. And on the aggregate, you can say, well, 60% of my trades are winners and 40% are my losers. But I made on a data set of 5,000 data points, not on 1 or 2 trades a day, which means the random variable is overwhelmingly influencing your returns. Now, if you have patience and discipline and you have a process, a methodology, you behave tactically well, and as a scalper, you're only tactical. There's no strategy. There's no macroeconomics. You're not worried about GDP in this country versus that country. You're just trading the volatility, and you're using pure technicals for that. That's great. And if you truly have patience and discipline and truly a methodology for entering and exit trades, then the more you do it, the more that provides consistency. And you'll have lucky streaks, you'll have unlucky streaks. But on the long run, out of 5,000 trades, you'll get a decent aggregate. But 2 trades a day is only 40 trades a month. It's nothing. It's not, right? It's barely statistically valid to even run a analysis on it. And it's only, you're only going to do 400 to 500 trades a year versus someone else doing the exact same thing, but they're doing it 5,000 times. Now, how do you do it 5,000 times? Well, use a smaller lot size. You're like, Wayne, well, the only way I make big money scalping is to have a big lot size. This is what you see by the idiots on YouTube. They ain't got no money, so they gamble big and they try to make quick. That's bullshit. And I swear to emphasize, the right way to do it is have smaller lot sizes. So individually, every single trade has significantly less risk. So I'm telling you the opposite of the other guys. Get as small and humble as possible per trade. And when that trade becomes a winner, move your stop to break even, then take another small one. The secret is smaller lot sizes, not big. On most hedge funds are not algo funds like that. There are certainly more important things to be worried about. That doesn't worry me in the slightest, not even the slight, not even in the slightest. So smaller lot sizes give you a bigger aggregate. And I need to emphasize, I said, if you're truly patient, disciplined, and you truly have your scalping methodology, you know You have a technique, what I call tactics, and you consistently employ that. Then you should have your aggregate outcome of 60% winners or whatever it is. Maybe you're 70% winners. They're smaller little trades. You're knocking down 10, 15, 20 at a time. You're quick to get out. Great. Now, if you do that 5,000 times and you are good and have patience and discipline, that'll be great. You'll be fine. The second part of it is you never, ever, 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 ever take big losses. Ever. If you're trying to cover up your piss poor performance as a scalper by having you're quick to get out of trades, like, oh my God, I made 12 pips. Meanwhile, you got negative 40, negative 50, negative 60, negative 70, negative 80, negative 90. Oh my God. You're actually the worst trader in the world. And if that bruises your ego, you got a problem. Okay? You see? So smaller lot sizes, consistent behavior, and a large aggregate so that you get rid of random and you replace it with average. Okay? No, Abdullah says, so what's the average? I don't care about, I think it's actually the dumbest thing to worry about is your risk, your percentage, right? Of win-loss percentage. I want you to have better math in your thinking. I want you to say, for every 33 pips you risk, you will hit your 99 pip target. Or if you don't think you can make 99 pips, you don't take the trade. Okay? If you can't put something together like that, it's not worth the trade. Now, under this, Abdullah, you can have 66% losers and not lose any money. I want to get you there as a starting base, as a foundation. Okay. Now, On says, how many swing trades should one have in a year? Well, some of that is a function of money. Okay? So, I used to have a rule for every $100,000 in cash, I would trade one mini lot. And some of you guys have probably 2,000 in cash and trade 3 mini lots. You're way over leveraged. So you wouldn't be able to afford many trades. Okay? Now the second thing is, if you have a small lot size, you can take more trades. So if on a Friday afternoon or a Sunday evening, and you're setting up your trades for the week, okay, you might do analysis on, let's say, yen. And your analysis says you want to buy yen pairs, so you want to sell yen. Okay? And so you got $100,000, and you could place 5 mini lots on 5 different yen pairs. Place a negative 99 on each, and now you're risking 500 pips. And on $100,000, that's not a big deal. Sorry, it's $500, right? Not a big deal. On 100,000, right? So you have 5 trades risking 0.5%. But if you get it right, let's say you're going for 333. Yeah. So you're risking 500 to make 1,500. So for that week, you're going for 1.5%. Now, for the month, I would be tickled pink if you can get 2 to 3%. That makes you the top performing Forex trader in the United States. That's per month. Okay? If you had $100 million, and that's a tiny fund. Tiny. I have friends that manage $300, $400, $500 million, and they're tiny firms. Okay? So if you had $100 million and you're making 2% a month, you are the best trader in the entire United States, according to Barclays Hedge, and database of commodities trading advisors, CTAs. You are the number one in the United States, which means you're probably not going to be there long, and it probably means you're over leveraged. Okay? But here's the thing. Since each individual trade is so tiny compared to your cash, and the losses are so tiny compared, your risk is so low that you have enough. I mean, now you're giving it 100 pips stop. I bet you as a scalper, you're not doing that. And there's lots of room to breathe. You don't have to have perfect entries and exits. You're removing luck out of it. The only way you're really going to lose is that you are really 100% wrong. And you want to be out of a market when you're 100% wrong. But you've removed almost all luck. And you've removed almost all risk. Your worst week is a 0.5% loss. So your worst month is -2. You can recover from that. And your best month now is significantly better than that. You put yourself into the potential of a 6% month. Well, that does happen, but not often. You need everything to line up, but it does happen. If you're consistent. If you're random every day as a scalper, then forget it. But now I'm addressing how to be a swing trader. So now you're trading macroeconomics, you're trend trading, you're buying dips and such. So you're probably, now I want you to listen to it's math. You're probably not going to lose because you are buying dips in an uptrend. So you're already waiting for a decline. Then you buy because it's an uptrend, but you already bought it at a 30% discount or a 20% discount or whatever. You're buying it at support after a retracement. So for it to fall through support and drop another 100 pips, forget it. It's not likely. It's possible, but not probable. And if it does happen, you want out anyways. You're like, oh, thank God I got out with a 100 pip loss. Thank you, Forex gods. But you're betting on the trend. So you're probably going to make money. It'll probably go up. Will it go up 333? Well, we don't know. At some point, you'll move your stop and you'll add more. And you'll add more. And you'll add more. And you'll add more. Then you'll hit targets. Then you're out. Some of them will be higher than 333, maybe. Or maybe you'll always get out at 333. Or maybe you get out because you hit a monthly target and some of them are, only 111. But you hit the target, so now you're out. But nonetheless, your risk reward works. The math is solid. If you knew the math, then what you see on YouTube of these small trades with big lot sizes shows you that they're children. Oh, they want to have a Rolex one day. They want to have a fancy car one day. Oh, are they saving for retirement? Are they putting kids through university at hundreds of thousands of dollars a year? Do they own assets like a house or a stock portfolio or a retirement account? Have they ever had a job? Do they even have a real education? No. But they'll gamble big because they don't have anything to lose. And that is the scariest thing ever. But oh my God, it's entertaining. It's a fool's errand. And it's a desperate dream that leads people off a cliff. And it frightens me. Yeah. It scares. It's scary. Have a great day. That was so uplifting. Cheers.